We have got a problem. The problem of conflict of interest. Whoever owns a particular asset tends to just praise that asset, tends to just market the asset. For example, with Bitcoin, people just say the positive things, not the potential risks. But that's an issue because whoever is an outsider and might consider investing into that asset doesn't really get a balanced view. Because here, for example, is a secret that a lot of people tend to just brush over. They tend to not talk about this. This is the number of active addresses in the Bitcoin network. And really, in the last 7 years, this has not gone up. The Bitcoin price is now 5 to 6 times higher than it used to be at the end of 2017. But the number of active addresses even slightly shrunk. So we don't have a clearly growing network anymore. It's not the usage of the blockchain that's pushing up prices. The question is this really a long-term healthy development? Yes, the number of transactions went up, but all of this was just inscriptions. It was just short-term speculation of NFTs on the Bitcoin blockchain. It turned out that inscriptions isn't really something that had a lot of real-world use case, and it tended to die down. But have a look at this. This is the Bitcoin transfer volume. So how many Bitcoin get transferred every day? And this is also simply just going sideways. Now measured in US dollars, it tends to go up because when the same number of Bitcoin is getting transferred, but the Bitcoin price itself is going up, then of course the US dollar transfers increase in line with the price. Now, if we are really objective about it, if we pretend for a second that we do not have any stake in crypto at all, we are not invested at all, we are an outsider looking at those numbers, this is not necessarily that great. One of the main arguments of the Bitcoin maximalists is that the price should increase because of network effects. But if the network isn't growing, if the number of active addresses isn't growing for years on end already, then how strong are those network effects really? I try to be as objective as possible on this channel, even though I do have a stake, a heavy stake in Bitcoin. But I do not shy away from data like this. This is the address count by cohort. So how many addresses own Bitcoin? And of course, there are more smaller addresses than larger addresses. But again, we do not see any growth of the number of addresses in the last 2 to 3 years, roughly. Let's take away some of those smaller addresses. Now, every wallet that's plotted here has at least 10 Bitcoin. So that's $1 million, more than $1 million worth of BTC. But let's go one more order of magnitude up. And this is now at least 100 Bitcoin. So at least 10 million worth of Bitcoin. And this is where we do see a slight change. While the number of small wallets isn't going up, the number of very rich wallets is. So this is partially a rally that's driven by the ultra high net worth individuals. Now $10 million worth of Bitcoin is a lot, but it's not as much to be counted as institutional money, right? This is not centralized exchanges. This is not ETFs. This is simply just ultra high net worth individuals, potentially family offices, potentially smaller hedge funds that have a stake in Bitcoin. This is really where the adoption recently happens. And that's what's driving up the price. We all know that the ETFs tend to just accumulate over time. So we've got the Bitcoin price in the background. That's the line in black. And the line in purple is how many Bitcoin is held via the various ETFs, with the largest one being IBIT. That's issued by BlackRock. We do have short periods where actually this balance is going down, but over the long term, we just see accumulation. And it seems like that accumulation is even accelerating. It took 4 years for the ETFs, or rather the ETF-related instruments, like the Grayscale Bitcoin Trust, to accumulate 0.8 million Bitcoin. Subsequently, it only took 2 years to double that amount. And on top of that, we've also got the purchases by the Michael Saylors of this world, right? The Bitcoin treasury companies. So really what's going on here is that Bitcoin has changed in its nature massively. In the early days, Bitcoin was used as a peer-to-peer cash, as it was laid out in the white paper. It was used on Silk Road to buy goods that were not necessarily always 100% legitimate. It was used also for short-term speculation, right, with Mt. Gox being the major centralized exchange at the time. But there was really no big money involved. This is now changing. Seems like there's less and less peer-to-peer transactions. The number of active wallets tends to be flat, but now the price is going up because Wall Street continues to buy. Bitcoin is now more and more a store of value and not peer-to-peer cash anymore. It's great that there is the feature of transferring Bitcoin without any third party. That's also what's giving it its value. But it's not the major use case right now. The major use case is simply just investment. It's storing value over time, not getting inflated away by fiat currency expansion, for example. And this, of course, works because of Bitcoin's adoption and its tokenomics. This is the circulating supply over time, so that's the orange area, and the inflation rate, that's the red squiggly line that tends to drop by 50% every 4 years, right? This is the halving. Right now, we are at 0.85% per annum inflation rate. This is how much the supply of Bitcoin increases every year, much less than fiat currency, which expands by roughly 6.8% per year. And so this chart is a great expression of how Bitcoin is used less and less for transfers and more just for storage. It shows the circulating supply versus the transfer volume. So again, the circulating supply being the orange area, and the transfer volume per day measured as percent of the supply is the blue line. And this tends to go down over time. There tends to be only 1% of Bitcoin moving around every single day. We can also remove that and just have a look at this red area over here, right? This is how much Bitcoin is actually moving every day on chain. It's a tiny, tiny fraction of the overall. Now, how does this information help us? It helps us because it shows how more and more of the Bitcoin gets just locked up, stashed away, and doesn't get into circulating supply. Thus, whatever additional dollar gets into the system tends to push up the price more and more. As there's less liquid supply out there, there's more price sensitivity to capital movement. And so really, it only makes sense to sell Bitcoin when there is too much attention, when there's too much usage of the blockchain, and when there's potentially short-term hype around the price action. Have a look at the fee revenue as percent of income, or in other words, how much do people have to pay to the miners to get their transaction through? How busy is the blockchain? And when this is very high, it might make sense to at least temporarily take some profit. It doesn't work perfectly, but it definitely shows that the market right now is not very heated. The Bitcoin blockchain is rather stable right now. There's not too much hype. Have a look at who's currently holding Bitcoin based on the holding duration. So we've got the entire supply again, which tends to increase, currently by 0.85% per year. And then we see how long has the Bitcoin been dormant in a wallet. Now have a look at the Bitcoin that has not moved for the last 10 years. And let's also remove the Bitcoin that hasn't moved for the last 7 years. We could argue that the majority of those Bitcoin have been lost, right? If you've never moved a single Bitcoin for the last 7 years, it's unlikely that you're going to do so in the near future. What do we now see? We suddenly see that Bitcoin really is not inflationary at all. It seems like the same number of Bitcoin is getting lost, potentially even more, compared to what's getting mined. Because probably among the Bitcoin that have moved in the last 7 years, some of them might already been lost and they're simply not yet counted. So over time, more and more Bitcoin will gradually migrate towards those longer age bands. And so really, Bitcoin has a stable, potentially even net shrinking supply. Yes, there is mining, but more Bitcoin gets lost. And then, of course, we've got all of those entities that just continue accumulating non-stop, that tend to not be net sellers. 1 million Bitcoin held by the Bitcoin treasury companies, that's 5% of the supply. 1.4 million Bitcoin, that's 7% of the supply. So we've already got 12% of the supply being in diamond hands, being distributed among investors that tend to just keep the assets long-term as a store of value and as a diversifier in a portfolio. Now, when everything is so rosy, when the long-term looks so great, why do we sometimes see these massive crashes in the Bitcoin price? This 70, 80% crashes. The reason is short-term holders. So have a look at the realized cap hodl waves. This is how much capital is moved at a particular point in time based on age bands. And we can see it's especially the short-term speculative money that's active at the end of a bull run. And then once we bottom out, it's the long-term holders that just continue buying in. They just dollar cost average. Here's a slightly different way to look at this. This is a long-term holder realized cap hodl wave versus a short-term holder realized hodl wave. Long and short-term holders are segregated by roughly half a year of holding duration. So when it's less than half a year, it's short-term. When it's more than half a year, it's counted as long-term. And again, this peaks whenever the market is very heated and when it might make sense to take some profit. Currently, we are not there. This current bull market is very stable. It does not become faster and more heated and more short-term speculators come in. This is not yet the case. Yes, the market is of course a bit more active compared to when we were only at 16K, but it's very far away from the danger territory we have seen in the past. And the great thing about this entire system is that even though we do see the accumulation by the ETFs and the treasury companies, overall, if you look at who owns Bitcoin, is it the very small retail investor? Is it the institutional investor? The balance tends to not change that much. So the shrimp that has less than 1 Bitcoin, that's here in red. The crabs between 1 and 10 BTC, that's in orange, etc. So of course the whales do have a lot of BTC, but it's not like they're expanding their ownership that rapidly in the grand scheme of things. We can also normalize this to 100%. And again, it's not like the whales or the mega whales take more and more of the entire supply. They're not dumping on retail, but they're also not selling. It's simply just a very constant, somewhat equally distributed market. And so the takeaway of this video is that even though the transaction usage of Bitcoin is not increasing over time anymore, even though that's at the exact same level compared to 7 years ago, its usage as a savings vehicle definitely continues to grow. Bitcoin really is not peer-to-peer cash. It's rather peer-to-peer virtual gold. And the market will continue to go in cycles. It will continue to heat up over time as the price appreciates. And it might make sense to take some profit, even though this is the hardest of the monies. It might make sense to take some profit when the short-term holders are taking over. When it's not anymore the diamond hands that hold Bitcoin, but when it's the short-term speculative money that just wants to flip Bitcoin very quickly. We aren't there yet. The demand for Bitcoin block space isn't that high. The transaction costs are low. The short-term holders aren't yet dominating the trading. So everything, at least for the next months, seems to still be very healthy. Now, fundamentally, there are two ways to make money with investing. The first way is to just bet on long-term adoption and to bet on monetary debasement. So that's the idea of dollar cost averaging, right? We buy into Bitcoin all the time. We just bet on the long-term growth chart. For example, had you bought $1,000 worth of Bitcoin every month for the last 5 years, so you held Bitcoin for more than a single cycle, then you'd now have $213,000 worth of BTC, and you outperformed the S&P 500 and the gold market by more than 2x. The reason why such an approach works is because more and more capital long-term flows into the asset. So more people buy the asset without the intention of selling it. More and more people just buy the asset in order to preserve purchasing power. This works with Bitcoin. It also works with the property market. It also works with the stock market. People don't necessarily buy those assets in order to flip them quickly. So have a look at the number of wallets that own at least one Bitcoin. This tended to go up long term. This growth has stopped to a degree 2 years ago, but now we've got Wall Street that instead buys the Bitcoin. So there's still long-term adoption and thus Bitcoin price appreciation. The treasury companies, they never sell, and the ETFs also rarely sell. There's only very few instances where we see net selling. We really have to zoom in to see those kind of events. So that's approach number one, right? We bet on adoption, we bet on further capital accumulation, but then there's also approach number two, and that's trying to beat the market, right? It's trying to buy low and sell high, and effectively what we're doing there is we're taking money away from the person that's not able to time the market as well in order to get outperformance. So if you want to get more performance than the average investor, we effectively taking it away from the investor that doesn't really know what they're doing. So let's say we are using tools like the realized price, right? The average cost basis of the market, and we buy much more Bitcoin whenever the current price is below that realized price. Then of course we are buying when everybody is very skeptical about crypto and Bitcoin. We are in a way doing a contrarian bet. nobody wants to buy Bitcoin, so we do. The same is true when Bitcoin is high, right? For example, here, the CBBI indicator, we want to sell when this is rather high, when everybody is hyped about Bitcoin, when everybody thinks that Bitcoin will go to the moon and the rally accelerates. That's when we want to potentially exit. We are not yet at those extremely high levels. But again, we always want to do the opposite of what most other people are doing. Because that's the way to make money in crypto, right? The minority is able to beat the masses. The masses tend to do the wrong things. Only the people that do the opposite of what most other people do, they accumulate above average returns. If you do a 2x on top of just buying and holding Bitcoin, then you basically took all the money away from somebody else, or you took 50% away from 2 other people. You get the gist. And so that's why I like the crypto market. And that's why I don't speculate, for example, on the currency market, because the currency market is extremely efficient. It's got all kinds of quants and hedge funds working for it. It's a very large market. It's incredibly hard to beat. When we are taking money away from the people that aren't as smart in the market, we're basically seeing all the other market participants as competitors. And we want to have very weak competition, not strong competition. We don't want to have the Einstein hedge funds as our competition. That's why the currency markets are very poor for active speculation for the average person. And the same could be said potentially for the stock market, right? The stock market also tends to be somewhat efficient. Before my time in crypto, many years ago, I was actually a professional poker player. I paid my study fees, my private tuition with the earnings from poker. I lived from poker several years. I used to live in Gibraltar at the time. With poker, I learned that it's not just the skills that matter. It's not just about calculating probabilities and reading tells, etc. It's also about who you're sitting with at the table. If the table is only made out of sharks, it's only made out of other professional players, then there's no money to be made. But if you're sitting at the table where all the other players are just beginners, then you don't need that much skill in order to beat the game, in order to make money. And it's the same concept here for speculation. If we want to outperform the average investor, we better participate in assets and in markets where we're mainly sitting at the table with fish, not with shark, right? We want to be in a soft market, in an inefficient market. And so here is where I see the inefficiency in crypto. Crypto as a whole is already comparatively inefficient, at least in relation to the currency market or to the stock market. But really, the main inefficiency comes from token dilution. For example, have a look at this. The Ape token has a lot of token dilution. Here is the number of Ape tokens over time. 3 years ago, this was at 284 million. Now it's at 908 million. There's all of those new tokens that get issued all the time that goes to the insiders and to the team and to early investors, etc. They get new tokens and they dump those tokens on the market. And this is not a new concept I'm talking about just recently. I even talked about this specifically for the Ape token just a few months ago. Have a look at this video. How solid is the Altcoin rally? This was published 9 months ago on the 22nd of October. At the time, the price was at $1.57. And here we are today at 63 cents. We had a massive rally in the Ape price at the time, but relative to Bitcoin, Ape went down massively afterwards because the rally was triggered by some news event, right? People got very excited about Ape and then the insiders dumped very quickly. It's something that's not really surprising. This is an underperformance of 78%, and this is one sign of market inefficiency, right? If everybody is buying into a rally, despite the terrible tokenomics, that's an opportunity to make money. We're not buying Ape, we do the exact opposite. We are selling Ape that we don't have. We are shorting the Ape token. In other words, we make money whenever the price loses versus Bitcoin, Ethereum, Solana, the major cryptocurrencies that tend to appreciate over time. Now, Apecoin is just one example. The whole altcoin market has this problem, and the problem is massive. It's a structural problem that won't change anytime soon. Have a look at the value of the token unlocks of the newly hitting tokens that come to the market every single week. It tends to be at around 1 billion per week. $1 billion of tokens need to be purchased every single week just for the altcoin prices to stay flat. Now, the counter argument is that all cryptocurrencies are inflationary to a degree. Even Bitcoin is. But compare this with Bitcoin. Bitcoin's inflation rate is at 0.83%. And that is per year. The market cap of Bitcoin is 2.34 trillion. So when we multiply the numbers, we've got potential sell pressure of 373 million per week. Roughly 1/3 of what the altcoins need to be bought at. So Bitcoin has less selling pressure, and at the same time we've got all of the supply absorption by the ETFs and by the Bitcoin treasury companies. And so when there's an asset that's less inflationary, that has less sell pressure, and at the same time has more buying pressure due to Wall Street, then of course that asset has to outperform. And historically we have exactly seen that. Since beginning of 2022 to today, the Bitcoin market cap relative to the others market cap, so the market cap of the smaller altcoins, has gone up by 291%. But this is actually underrepresenting the problem, because this is again just comparing market caps. But the prices tend to go down for the altcoins much faster because of the token dilution. So let's say we've got an altcoin of $1 billion of market cap. Now we double the amount of tokens, and thus the token price gets cut in half. The market cap would still be the same, right? The token price went down by 50%. The market cap is unchanged. So the underperformance that we get from the token dilution isn't even presented here in this chart. This chart just shows how long-term people are exiting the altcoin market in favor of, in this case, Bitcoin. But the chart relative to Ethereum and relative to Solana looks pretty much the same. Here's another example to show the difference between price and market cap. This here's WorldCoin. WorldCoin supply went from 522 million to currently 3.8 billion. So roughly a 7x in the supply in the span of just 2 years. The WorldCoin price is close to all-time lows. The WorldCoin market cap is quite close to all-time highs. It's not that close to the low. Again, the market cap can be rather stable while the price is crashing. Again, the market cap can be rather stable while the price is crashing. So really, you're getting the return of the price, not of the market cap. And that's why most retail investors lose over time. Have a look at Bitcoin relative to WorldCoin. It's just going up. Or have a look at Bitcoin relative to Ape. It's also just going up. And this is, I believe, the key to making money in crypto. It's to take advantage of that inefficiency. It's to make money with all of that marketing dollars that are spent by the team, by the early investors, to attract other retail investors to buy things like ApeCoin or WorldCoin. So then a lot of liquidity is in the token that then the insiders can dump on that liquidity. But we can make money from that dumping simply by betting on falling prices of ApeCoin or of WorldCoin, at the same time betting on rising prices of Bitcoin, Ethereum and Solana. So we're playing exactly the delta of those two assets. That's why we get this long-term appreciating trend. I just took those two examples over here, but again, this is a structural problem with the altcoins. The selling is much, much higher than the market can digest. It's even higher than what we have for Bitcoin, as we've already discussed. I'm making money with those relative valuation bets already for more than 4 years. And had I just dollar cost average into Bitcoin, I of course still would have made a lot of money, but because of the relative valuation bets, I didn't just get the return that's indicated here by the gray line, I got the return that's indicated by the black line. So this is something I'm doing already for a long time, quite successfully, quite consistently. And recently, I even started a capital pool for the premium members, where I execute exactly that strategy. And so far, after 1 month of trading, this is already bringing us annualized 74%, very consistently with a maximum drawdown so far of 2.6%. So really, I don't think that the edge in the crypto market is to find the next 5 or 10x altcoin. I think the edge in the market is to simply continuously, quickly grow the capital with little volatility, but to use the market structure to our advantage. With a random meme coin gamble, we can only invest a few hundred, maybe a few $1,000s. But when we actually have consistent growth with not that much volatility, suddenly we can invest much more capital, right? Investing a lot of capital into Bitcoin feels much better than investing a lot of capital in a small meme coin, right? We can deploy more capital. Thus, even if we don't have 10x returns in the span of a few days, it doesn't matter. If we've got above average returns consistently, if we've got a high Sharpe ratio, we are okay. Now, unfortunately, due to extreme demand, I had to close deposits for the copy trading pool. There will be a new capital trading pool starting at the beginning of next year, but right now I simply trade with the capital that I got from the members. But you can still manually copy trade me. For example here, right, this was the WorldCoin short. I bet on falling prices of WorldCoin and on rising prices of Ethereum. That was on July 23rd. And so many premium members simply copy trade me, right? There is quite a lot of gains to be made in those individual transactions. But it's not about the individual transactions, right? It's about the long term. It seems like quite complex, right? We go long one thing, we go short the other thing. It also sounds quite risky. But really, in the end, if we set this up properly, it's not that risky and it's also not that complicated. There's really only two videos to watch. It's this one, using perpetual futures on Hyperliquid, and here this one, probably even more important, risk management with relative valuation bets. It's only 1 hour of content. After this 1 hour, you know exactly what to do in order to get performances like this. And you will also know what to do in order to just copy trade whatever I do, so that you get the same kind of returns that I do. So really, just watch this video and watch this video, and you're good to go. I'm not going to read it out in this video, but feel free to stop the video and read the feedback that I get. It's always nice to get this kind of feedback. If for whatever reason you do not like premium, then just message me within the first 7 days of signing up and I refund you the fee. It's currently $125 per month. If you don't like it, you'll just get that money back. Just message me. A link to premium directly pops up over here on the screen. Just click on that. It will lead you to the website. If it's the very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. Cheers.